Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope you're having a good day out there and all is going well. Hey, we're financial advisors here at Jazz Wealth. We do a quick series that you're watching now. We call it Fin Tips, really just to teach you something new, get out of your way. You can go on and hopefully learn something. We're teaching advisors here. And what I'm going to share with you today, you're never going to see a financial advisor teach you this, and not because they're bad people, but because most financial advisors, almost all financial advisors, don't actually manage their own portfolios. They buy mutual funds or some mix of ETFs. They hope that works for you, and they send you on your way and charge you along the way too. We actually manage our own portfolios, and so I like to teach you how we do things, at least on the surface. And then, hey, maybe if we're a good fit for you, maybe you'll check us out. If not, and this helps you learn how to build your own portfolios, I just want you to take it a step further. So we're going to dive into this here today. And what we're talking about is an expansion of the dividend portfolios that we've been talking about building. I'm big on volatility, so I don't like to just randomly pick dividend stocks. Our dividend portfolio is widely diverse with a whole bunch of different criteria, but today I want to focus on you guys. So I'm going to first do a scan for dividend stocks, and you can, of course, adjust and go research for anything that you like in particular. Then we're going to drill down and show you how to pick an individual stock. So let's get started here. First thing we're going to do is look up a scan, and I just sort of organized this in order, try to help you visualize this a little better. There are a bunch of stocks you can choose from all over the world, 22,620 to be exact. We just want to trade stocks here in the U.S. We want to look at the S&P 500. So I did this in particular so that you would have a narrow search that you could do on your own. That narrows us down to 64 stocks of what is considered higher dividend stocks in the S&P 500. What that means is any dividend stock that is higher than the overall yield of the S&P 500. So for example, if the S&P 500 yield was 2%, we just wanted a list that was anything better than that. We also wanted a consistent history of the last 5 years of them paying a dividend, and we wanted it to just be a quarterly dividend. You can go into monthly and get sort of hybrid scans if you like, but that's we just try to keep it simple. And so we boiled down to 56 different names. So if we go down here to the bottom, or towards the bottom, now we've got this list, and I sorted them briefly here by dividend. A lot of people are going to go, ooh, give me the highest dividend, man. I want to get paid on that. Okay, that's fine. But what I wanted to share with you is, number one, you want to look at the dividend that they pay. A penny for Occidental Petroleum is probably not going to excite much of you, but the 12% may grab your eye. So just take a look and see what the dividend is that they are currently paying. Anyways, I also wanted to highlight the sector, because a lot of people are saying, hey, I don't want to be too focused in one area. I want to be diverse. It makes sense. You're taught that, right? Be as diverse as possible, because there's always something going on in each sector. There's always a fire that they're trying to put out. Oil stocks having their mess right now. Retail, of course, is having their mess. And so you always just kind of want to be diverse when you can. Let's pretend today that we're trying to pick one stock to add to our portfolio, and we're already diverse. We're just trying to look through and just see if there's any new opportunity. Well, the first thing I noticed right away is that energy is in the top picks here quite a bit, more so than any other category at first glance. So let's say you've got real estate already, you've got a bank in there, and you're like, all right, I need an energy stock. I've got a lot to choose from. So what you could do is say, well, let me just find something that has about, I want to compare two stocks that have about the same yield. As I look through here, I kind of see Schlumberger. I'm just familiar with the name, so I'm going to look at that one just to catches my attention. And of course, ExxonMobil, that catches everybody's attention. So I'm going to go with this today. I'm going to say, all right, we're trying to decide between ExxonMobil and we're trying to decide between Schlumberger. Maybe price is a focus. So over here, I've got the price, $19 for this one, $47 for this one. But with fractional shares these days, most of the time price is not too big of a consideration just to start participating. All right, so let's say you said I need an energy stock. I'm going to pick between Schlumberger or ExxonMobil. Now what I want to know is, how do I pick? Like, why would I choose one over the other? Price is not a focus. If it is, maybe Schlumberger beats it out a little bit. You might think performance, but that's not fair, because I could just make a video here and highlight the best performing one and say, see, I told you so. So we really don't want to focus on price for the reason of learning, right? We want to focus on, how you would zoom into this. So we've got yield, basically 8% for each one of them there. They're in the energy sector. We're happy with that. The next thing we want to look at is, in order to achieve the returns, whatever they were for each individual stock, how much did we have to suffer? How much were our returns spread out? In other words, if I told you that I could give you a stock that returned 1% a month on average, right? And anytime it wasn't 1% a month, it was either 0 or -1. It never went above 1%, so I'd take back the average comment. So it never went above 1% and it never went below 1%. It was always somewhere in there, but most of the time it was towards the top. Would you take that over a stock that I say it would also return about 1% over the long term, but its range was plus 12% one month, minus 12% the next month? You'd say, well, if I'm going to make the same amount, I'll take the one that's a little less scary, right? I'll ride the kiddie roller coaster and not the crazy one, right? It makes sense. Now, I have to focus on that with our customers here because I can't have a dividend fund that's wildly moving around. I'd have a bunch of customers leaving bad reviews, if you want to look us up, and they would be rather frustrated. So I respect that. I know that. And so when we look at this here, what we're going to do is try to find not just the best returns, but the least amount of volatility. Now, hang on tight because here we go. So here's sort of a breakdown. I put these on two different levels here so we could break this down. On the top, what you see is ExxonMobil and Schlumberger. What we're doing is we're looking back 20 years from this point, actually this actual day. We're looking back 20 years and we're saying, okay, the performance is what it is, that's fine, but we're trying to find the least volatile pick with the best possible performance. So what you see up here at the top is the return over the last 20 years. You see the return for Schlumberger. It's had a bad run apparently. You've got the annualized returns, 0.88% over the last 20 years would be your annualized return. So every year on average, 0.88%. Negative 3.11 there. So I don't care that it's negative or positive. What I'm looking for is if I'm going to make the 0.88% or I'm going to sit and just feel maybe I bought a discount, maybe the stock is discounted and I'm going to suffer through an average annualized return that's a loss, I better get lower volatility for it. Now at the bottom what you can see is the actual range of the monthly returns. I don't like saying standard deviations because it tends to make people's eyes gloss over, but here's what we're talking about. Over the last 20 years, in the orange, you've got Schlumberger, and in the purple, you've got ExxonMobil. So over the last 20 years, Schlumberger has averaged a negative 3.1% return for whatever reason, but it's had a range of plus or minus 10%, meaning 1 month you're staring at a double-digit gain. The next month, you very easily could be staring at a double-digit loss. And so you're riding this roller coaster quite aggressively. Okay, maybe that's okay with you, but if I'm not getting a positive return or I don't see an opportunity to do that, I don't know that I want to ride that roller coaster. If I look at ExxonMobil, I see, okay, average annualized returns, not great, not bad. I get that they're going through some issues. Remember, it pays the dividend, so I'm happy with that. That's all I'm looking for. But my ride is a little less wild. I never quite go to double-digit gains versus double-digit returns. And so what I'm able to do is just look at this and say, if we're focused on performance, we'd probably go pick a few other stocks and try to find any better performing stock. But if we're focused on volatility and yield, if we want that 8% yield or roughly wherever it's at, we want to do it with the least amount of volatility. And in this case, the answer is ExxonMobil. Now, I am in no way suggesting you go buy ExxonMobil. What I'm just trying to show is if you have about the same yield, would you not want to go with something that's a little less wild of a ride? And that's really our focus today. Am I on point? Is this the kind of thing you like? I like talking about it. I could talk shop all day long. I have no problem doing that. But let me know what you think in the comments below. This was one area. This may help you pick a stock in an energy sector. Maybe now you move on to retail and financial services or wherever you go and start to build out this really smooth dividend portfolio that you don't have to stress about on a day-to-day basis watching it wiggle around like people that just randomly pick dividend stocks. Hey, I hope this helped. If it did, do me a favor, hit the subscribe button. I'm supposed to tell you that, so I appreciate it if you did that. And we'll be back to do some more. Later, we got the Closing Beat Show, 5 o'clock. We go over the stock market in the same geeky respect, non-biased, just kind of go over things, and I hope you'll check it out. Enjoy the rest of your day, and maybe we'll see you later.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.